lowest level in 3 weeks. Let's bring in Richard Gorry, lead client liaison at Kepler. Richard, thanks for joining us this morning to talk through what's happening in energy markets. It seems as though the energy investors and traders around oil weren't expecting necessarily the reserve release that we got yesterday, confirmation from the IEA. We saw that pretty sizable pullback in the price of Brent. What do you make of this move, this coordinated action to release reserves?
Well, I mean, it's exactly what the strategic reserves were built for, right? They're there for times of emergency, and this is pretty much a time of emergency. So it's exactly what they should be doing. It's about all the consuming world can do. So I think it's the right move, and I think maybe the size of the release caught the market by surprise as when it was announced, but it's absolutely the right thing to do.
Where do we go from here? And I guess I'm asking that in the context of how far can these reserves take us, and what is the benchmark, or what will be the catalyst for releasing further reserves in the future?
Well, what we're looking at right now is about a 6 months release of about 1 million barrels a day from the United States. So that's quite a sizable amount. The additional 60 million coming from the IEA would then add probably something in the range of 300,000 barrels per day extra. So you're talking about 1.3 million barrels per day, potentially, if the timing is done correctly. So that's quite a sizable amount. Of course, it is coming to make up for a potential deficit in Russian supply. We estimate that to be about 1.5 million right now. So the release coming from the US and the IEA is not fully making up for the loss in Russian supply in theory, but it is helping to bridge the gap.
There is a lot of concern in Germany in particular right now around how to reduce the country's dependence on Russia, and there's a seeming reluctance to target Russian gas in particular, given how difficult it will be for Germany to operate without it in the near future. The German finance minister has talked about the country exploring its domestic oil and gas reserves in the North Sea as a potential way to plug a gap that we could face should the Russian supplies get cut off. Your take, is that a realistic option for Germany near term?
Look, not near term, certainly not. It is a realistic option as you go maybe 12 months, 18 months, 24 months down the road. But in the near term, that's not possible because simply it would take too much time to develop these reserves. So Germany really has, a very difficult situation in front of it because it is heavily reliant on Russian gas. And if the sanctions were to be, raised to target energy flows, then, clearly you would have to see major disruptions to demand in Germany over the course of the next months.
When it comes to potential sanctions on Russian energy, you've got coal, you've got oil, you've got gas, and European leaders, I suppose no surprise, are willing to target coal, much less willing to target gas as a unit overall. From Russia's perspective, they, I believe, have said that if Europe were to ban oil imports, then Russia would look to ban gas exports because gas is so important to Europe and oil is so important to Russia. I mean, how do you see oil versus gas turning up in a potential sanctions package from Europe, given those factors?
Well, I think that's exactly it. You hit the nail on the head there. It is a give or take. If the Europeans want to target oil, which would be, let's say, the final line in the stand, then the Russians would retaliate and target the gas, and it would be self-destruction, kind of mutual assured self-destruction in the economic sense. So I think that's the way we are at play right now. And I think anytime the rhetoric is moving towards oil sanctions, you do see the Kremlin start to talk more about potential cuts to gas. So this is clearly the standoff that we're in, and will continue to be in until we have some sort of easing in the situation in Ukraine.
Richard, looking at the price of oil, now that we've had these reserve releases confirmed, where do you see the trading range for Brent and WTI in the weeks and months ahead?
I mean, it would be very, very difficult to be a bear in the current market because simply there's so many political variables at play. However, I mean, we have seen a bit of a correction overnight. The release is certainly going to help to fill a potential gap. So that is definitely giving a little bit of relief. If we look at the backwardation in the market also, that has come in quite sizably, showing maybe that the trading market is a little bit more optimistic about supply. So that's come back into a more normal range, I would say. But there are obviously lots of things at play here in terms of Russian supply, that could easily see the prices go up. The downside risks are probably less so, but we would have, of course, the ongoing COVID situation in China. That is a problem, and potentially, a deal for the return of the Iranian nuclear deal, which could see, Iranian supply come back into the market. But generally, I would not be betting on a strong drop in oil prices.
Richard, thank you for sharing your insights with us. Really appreciate it. Richard Gorry, lead client liaison at Kepler. Let's get a